No. Poi ti chiederò magari di spostarti un attimo.
Sì.
Hello everyone, this is PyDataVE coming to you from Andavenice Hostel. Tonight we'll have two talks focusing on different aspects of machine learning system and more. First, let's thank the supporters of this edition, Andavenice Hostel for hosting us, and Curly Cloud for the streaming. As usual, we'll start with the talks, each followed by a short discussion. After that, I'll share a few updates about upcoming events. And finally, we'll move on to some in-person networking. Start now for, we can go and let's give the floor to Tomas with his talk on how global warming drives connectivity loss among climate typing elements. So, give me a second, because I have some.
Okay, so thank you very much. Thanks to Alessandra, the organizer, for inviting me. And I am Tomas Scagliarini, and I work as a researcher at the University of Padua at the Comune Lab. And today I want to discuss about global warming, and in particular about how this global warming drives the connectivity between tipping elements, climate tipping elements. But before starting, I want to make a small disclaimer. So I am not a climatologist. I am a physicist. So in my group, most of the people of my group are physicists, and in particular we call ourselves complexity scientists. So we are data scientists, but we also study a lot complex systems. So climate is an example of complex system, but I want to briefly discuss what is a complex system, because we use this term a lot in our community, but I think it's important to distinguish between what is a complicated system and what is a complex system. So the difference is a bit subtle, but I think it can be explained in simple words. So a system that is complicated, just complicated, is a system that is composed by a lot of different parts which interact in a predictable and linear way. So, for example, you can think of like a car. The car is composed by many components, but they are predictable how they interact. So if there is the engine, there are also subunits like the engine, the transmission, So when something is broken, you can usually track what is going on, what is the problem. Another example is a plane, and so on. But okay, what is a complex system, on the other hand, is a system that, okay, it can be composed by many interacting units, even very simple interacting units, but these interact in a very unpredictable and often very non-linear way. So when something is broken, when there is a perturbation in some part of the system, this perturbation propagates in a very chaotic, unpredictable way. So what are examples of complex systems? Okay, there are many. For example, you can think of like the human brain. So the human brain is one of the most compelling examples of complex system because it's composed by very simple units, like the neurons. So neurons are the basic cell, and they do very simple things. So they just transmit electrical signal to other neurons. So you can also modeling the behavior of these units in a very simplistic way, but this interaction give rise to very complex behavior. We know that the brain is able to do fantastic things. There is consciousness, there is emotions from just the interaction of these very simple units. Other examples of complex systems are social systems, so how people interact, or even in ecology. Ecological systems are complex systems because the food chain, we can have very complex behavior of these, also even in ecosystem. But okay, the system that I want to discuss today is climate. So climate is another example of complex system. Why? Because okay, the climate on Earth depends on the interaction of different parts. So there is the atmosphere, there is the dynamics of the atmosphere, but there are also the ocean, there is the ice cap. There is also the interaction with the biosphere. Also the biosphere interact and perturb the effect of the climate. For example, the vegetation can change how the radiation from the sun is reflected by the Earth's surface, so influence the temperature. Or also in the oceans there are these bacteria that produces oxygen, and so impact on the climate. So this is an example of a system complex. So here there are also some properties that are very typical of complex systems. One of these is the possibility of, for example, tipping points. So what is a tipping point? Is the fact that these systems are very sensible to small perturbations. So when I give a small perturbation of this system, we can have like huge effect on the final state. In the climate, this has happened a lot in the past. For example, think of like the Ice Age. So the Ice Age is when, for example, there is a small perturbation in the orbit of the Earth around the Sun. So the Earth receives less radiation, but these affect a lot the temperature on the Earth. This is because there is a very complex interaction on, for example, the ice. So the ice so the Earth receives less energy, so the ice expands, but the ice reflects more the radiation from the sun, and this gives rise to like a cascading effect. So the ice expands, receives less sun, and then expand again, and so we have this huge effect that leads to this, for example, this ice age. So the climate is very unpredictable, and so in this work, what we want to do, we want to study the climate from the point of view of these tipping elements. So tipping elements are basically regions of the Earth, which are somehow important from a climatological viewpoint, and also can undergo this behavior, this tipping point. So they are very sensible to perturbation. I already discussed about the ice, but also, for example, the Amazon. For example, there is the Amazon forest, the coral reef, the ocean also. And another Another important thing to say is that these tipping elements are connected. So when we perturb one tipping element, often the effect is seen on other parts. Like, for example, I don't know, the Amazon forest reduces the amount of carbon dioxide in the atmosphere, and so these influence the temperature, but these, for example, the rising temperature can lead to the permafrost melting, and the permafrost melting can also liberate other carbon dioxide, and so on, in this sort of like cascading effect. So it makes sense to study the climate from the viewpoint of like interacting tipping elements. But okay, how do we study the climate? Okay, as I already said, I am not a climatologist. I am, say, a data scientist. So we want to study the climate from the point of view of a climatologist. So to understand what is the underlying physical mechanism which is behind tipping elements, because it's very complicated, basically. We want to use a data-driven approach. Okay, this is PyData, so we work on using data, and in climatology there is a lot of data freely available, and for this work we considered a data set which is called the CIMIC6 dataset, which is basically a repository of many climatological models, which again is free. They are freely available online, and you basically can download them for many climatological variables, like for example temperatures, precipitations, and many others. And also you can consider these are like climatological projections. So they tell you what will be the state of the climate in the future. And so we have, these are basically time series. You can see here on the right, these are like how they look. They are basically time series. There is a bit of pre-processing, so we don't use directly the temperatures. We use the temperatures anomalies. So we basically remove the effect of the average on a baseline period. So basically this is to remove any seasonality effect. So what you end up is that like these time series that you can see here. And these are like located on a global grid. So you have many observation sites, and you have basically the temperature anomalies in each one of these of this point. So what is also important that we can do using these climatological projections is that they are provided not only for one single scenario. So what are scenarios? Of course, these are like future climatological projections. We don't know what happens in the future. So the effect of these temperatures in the future will depend on the condition, the future conditions on the Earth. And the future conditions, of course, we don't know, will depend on what we do also as a unit. So, for example, we know the temperature will depend also on, for example, the amount of carbon dioxide in the atmosphere. So this is why we selected different. These projections are provided with different climatological projections, which are basically scenarios. These SSP, which are written here, are like I always forgot, but these are like social shared socio-economical pathways. So are basically social and economical scenarios. So basically you say, okay, now we start using all green energy, and so we have an optimistic scenario when there is when there is no emissions, basically. And then there is, so this is like the smiling face is like the optimistic scenario. Then there is like the medium scenario, and then there is like the bad scenario. Let's call it like the Trump scenario. So basically we don't care, we continue to burn fossil fuel and so on. And so, okay, we have this time series for these scenarios. So, but what do we do with this? Okay, we are interested to study the functional interactions between these observational sites, which somehow represents the state of those particular tipping element. So how do we do that? We study these very simple correlations. So correlations are like the Pearson correlation are basically the most straightforward way to extract information from this time series. We use also lagged correlation because, okay, the state of a tipping element now today can be correlated with the state of another tipping element like 30 days in the past. So we use this lagged correlation and we take as a statistic like the maximum of the lag correlation between two points, basically. And we do this for every possible pairs. These are like 2,600 observational sites. So there is a lot of like possible pairs. So we have this basically this huge matrix, this huge correlation matrix that you see here on the bottom left. So, but what do we do with this correlation matrix? So, okay, the usual approach in network science, but also in statistics, is to compute a p-value from a correlation. When you have a correlation, you can also compute the corresponding p-value, which is basically represent like the probability of observing that specific correlation if the null hypothesis is true. So this is easy to do it. You just need a null hypothesis. A null hypothesis can be computed by basically just reshuffling the time series and repeating the correlation. And so you have this kind of like bell curve, which represents like the distribution of the null hypothesis, and you can like compare what you have observed with this, and basically obtaining a p-value is just a straightforward way of doing it. And but this approach has some drawbacks, because when you have a p-value, the next thing you want to do is do a test. So you basically have to fix a threshold and say, okay, if the p-value is lower than 5%, then I reject the null hypothesis, otherwise I put to zero the link, basically. So this approach is very simple, but as I said, you have to introduce some thresholds, which is empirical, it's completely empirical. And so we don't like that. So here we in this work, we used like another approach, which we think is better, is also more principled from like a scientific viewpoint, and we use this is like a Bayesian approach. So basically the idea is like okay, we have these p-values, and from the p-values we want to compute what in Bayesian term is called the posterior probability. So this matrix that you see here on the bottom right of the slide, basically is what I just said. It's like a probability, is a probability of existence of a link between two locations, given the observation that you have done with from the original correlation. So how do we do that? Okay, so this is like a visual presentation of this Bayesian framework. Probably many of you already know. So the Bayesian perspective is like, okay, you have data. From the data, you can compute the so-called likelihood of the data, which is basically the probability of observing your data, given some model parameters. And the Bayesian step is basically inverting this probability, the likelihood. So from the likelihood, you can obtain the posterior probability, which is basically the probability of observing, of having your model, of having your model with those fixed parameters, given the data. So it's basically inverting the two things. So this is in a very simple perspective. So in practice, this is the way that these things can be done from correlation data. Okay, I skipped the mathematical details, but basically what you have to know is that from this formula represents exactly the posterior probability that I told you before. The only thing that you have to know is that this formula, which seems complicated, is completely data driven. So you have this b, which is the base factor, which is basically the p-value, is the logarithm of the p-value. And the null hypothesis is basically computed from the reshuffling the series and then computing this, the probability of the null hypothesis. So basically, with this formula, we can pass from the matrix of p-value to the matrix of this probability matrix, also called the fuzzy matrix, because you have this fuzzy, the probability of the link instead of like present or absent. Okay, so this is a kind of like change of perspective. And I also want to stress, okay, what is the advantage of doing this? So what is the advantage of having like a probability matrix instead of like just one realization of like p-value thresholded? Okay, there are a couple of advantages. Okay, first of all, as I said, you don't have to introduce an empirical threshold for your p-value matrix, which is, again, completely empirical. And another advantage is that since you have a matrix of probability, you have what in physics we call an ensemble. So an ensemble means that you can have you can sample from a probability matrix many metrics, just sampling every time the probability of existence of a link. So basically, you flip a coin. If the probability is low, the number is lower than the probability, then that link exists. Otherwise, you put it to 0. So you have all these networks, and from this ensemble of networks, you can compute, instead of having one single realization. So when you have a network, you can study, you can compute network descriptor, like for example the degree of the clustering coefficient. While with this approach, you don't have just one single number, but you have like basically a random variable. So for example, the degree of a node, you can have a distribution of the degree of a node because you have many realizations of the same network, of the same experiment. So this is also an advantage because you can compute error bar, you can compute confidence level, and this is also parameter free if you think about it. And okay, so going again to the problem of like computing the connectivity between tipping elements. Okay, this is an example. We have two tipping elements. We have like the Amazon forest, and we have this. It's called the El Niño Basin, which is an important region in the Pacific Ocean. Okay, how do we compute the connectivity? Because we have many points in each of the tipping elements. So basically, we use this formula. This written here on the right. Is basically the counting of how many points are connected from one tipping element to the other. This is actually a bit different. There is a slight caveat. So we consider like a weighted sum because we have to account for the fact that the Earth has a spherical geometry. So each point is weighted with the cosine of the latitude. These account for the fact that, for example, points that are closer to the pole represent smaller areas. And then there is a normalization factor. So this is, and also notice that we have an average over the ensemble matrix. So we don't have like a single number. We have many realizations, and we do the same thing, and we take the average, and we have this number which represents the connectivity between two generic tipping elements. Okay, so enough for like the theory. Okay, I will show you. I will give you some results. Okay, this is like the results from this analysis. So these are like the aggregation that I already told you. So there are, we consider like 13 tipping elements, so each matrix represent the connectivity between every possible pair of tipping elements. And here notice that each column represents a scenario, so there is the pessimistic scenario, the medium, and the optimistic. And then on the left there is the historical baseline. Okay, in this visualization we also show the effect of the lag, so the color represents the lag. But okay, I know what we are thinking. You don't understand nothing about this. There is no like clear message that you can think about. It's basically all equals. There are the numbers which represent like the connectivity. So maybe it's not the best way to convey the message. So that's why, okay, so that's why, instead of considering the connectivity, we computed the change of connectivity with respect to the baseline period. So we consider the analysis done over the baseline period, which is basically the pre-industrial period. So we computed like the connectivity, and then we computed the connectivity change in each of the possible scenarios. So here, okay, it's represented like a world map, but it's basically a matrix representation. So each tipping element is located on his specific geographical point. And in this visualization, what you have to know is that the colors represent the change. So when you see like a blue connection, for example here, it means that those two tipping elements are like reducing the connectivity with respect to the baseline, so many years ago. So you can see that, for example, let's consider like the scenario on the left, so the first column. Basically, all is white. White means that there is no change. So apparently, in the optimistic scenario, this connection between the connectivity pattern is stable, even until like the year 2100, which is remarkable. On the other hand, like in the medium scenario, there is in the first 30 years between 2040 to 2070, everything is kind of like even also stable. There are not many blue connections, but instead things start to change in the last 30 years of the 2100. And the thing is also even more, this effect is even more strong if you consider like the most pessimistic scenario, where we can observe how this connectivity pattern of changes is already active in the first 30 years of that we considered. And it becomes like very, very strong in the last 30 years of the 2100. Okay, so we can observe also that this effect is not homogeneous in all the tipping elements, and it seems that is particularly strong in the tipping elements in the northern hemisphere. And yeah, it also seems that these tipping elements located in the Atlantic Ocean seems like a central hub of these changes. And this has some explanation from climatological viewpoint, because this is like the Atlantic meridional circulation. But okay, I will tell you a bit more later. But okay, so we can extract a message from this visualization, from these results, at least. Okay, another way to see these results is, okay, we have seen the map, we have seen the matrices. What is the role of single tipping elements? So there are some that are more affected than others. Okay, here in this visualization, we basically see the total variation of each tipping element. So we basically sum over the rows of the matrix, and we have like 13 numbers, each one for every tipping elements. And again, okay, we see that in the optimistic scenario, there is basically no variation. So every tipping element remains basically with the same connectivity as the past. And yes, again, in the others, we observe some changes. But these changes, again, are not random. There are tipping elements that are affected more than others. And in particular, these are like tipping elements, they are ranked. So the first one are the one most affected. And we can see that this ranking is rather stable. So we see always more or less the same 4 tipping elements in all the scenarios and all the time periods. You may ask, what are these tipping elements? Okay, we have permafrost, boreal forest, the coral reef, and the one that I mentioned, the amok circulation, the one in the Atlantic Ocean. So these 4 appears to be like more or less the most affected on a global scale. When we consider this the total variation, the global variation. Okay, so what does it mean from what we have just seen? As I already mentioned, and for the third time, I'm not a climatologist, so I don't know. We don't know. We can just speculate, but this is not just for remarking the fact that I'm not a climatologist, but this methodology that we used is basically just data-driven, so we are not considering the physical underlying mechanism that is behind the tipping element. So it's difficult to understand what is the real cause of this decorrelation, because at the end of the day, these are like decorrelation of tipping elements as an effect of like increased carbon emission. But what is remarkable is that this effect is visible only in the scenario where the emissions, the human emissions of the anthropogenic forcing is very strong. So all the other things are being equal. So this points to the direction that human activity, for sure, but this is not a surprise, for sure have an effect on the dynamics of the atmosphere and the dynamics of this network of tipping elements. Another interesting thing is that these tipping elements behave they are not affected in the same way. So there are these 4 that are more affected than the others, and this effect is also strong in the northern hemisphere. So this again can be easily explained from the fact that most of the land in the Earth is located in the northern hemisphere, and we know that land is affected from climate change more than the ocean, just because the ocean has like a stabilizing effect from the temperature viewpoint. But it's also true that in the northern hemisphere there are most of the anthropogenic, most of the carbon emissions. So probably this has also something to do with the fact that we observe a lot of changes there and not in other parts. Finally, okay, in the literature there is a lot of discussion about the role of these amok tipping elements. There are signals that this part of the Atlantic Ocean, which is also responsible for like the Gulf current, is already showing a signal of like collapsing. So it's also interesting the fact that we observe that in the pattern of like connectivity change, we observe that this is also important with our analysis. And yes, okay, so that's what I wanted to say for today. I want to thank my collaborators from University of Padova and also other institutions. And thanks for your attention. If you have questions.
Thank you, Tomas. Okay, So why do we wait to if there are many questions online? Do you have any questions?
Just about the method, you showed some formulas, and there are always I and J, but there's no temporal variable. Is it implicit, or the analysis is frame by frame?
Yeah, this is a good question. I didn't mention this. The analysis is done on yearly window. So we have our data set is like from 2020 to 2100. So we basically have 80 1-year window. So we repeated the same analysis year by year, and then in the visualization that I show, like between 2040 to 2070, we basically aggregated the results at this 30 years window.
Your data set is like 360 days by...
Yes, a daily.
Does it fit in memory, or do you need a special library to...
Actually, it's a lot of computation because we have to compute a lot of correlation, like correlation. So of course we have to optimize, parallelize. It's not a problem of like memory. It's more a problem of like computing many times this lagged correlation. So is that the part?
Basic libraries you use, it's NumPy or?
Yes, we use the NumPy, and then the critical function we basically compile in C yes, with Numba, I think it's called. Numba. We use Numba to compile the critical function, which is that is like the bottleneck of the analysis. Yes. And we also use a cloud to parallelize. We use Cloud Veneto, which is like in Padova.
Okay.
Parallelized.
I have another question for physics. And I saw that you have an ensemble of probabilities. The first thing that came to my mind is to compute the entropy. I mean, not the physical entropy, the probability entropy. And have you computed year by year the entropy of the data set? Does it have an impact on your metric?
Yes, we try to study if these probabilities have some sort of patterns, if they are, because entropy give you information about the distribution, basically a map between the distribution of these probabilities, because if I understood that you want to compute, because actually we don't have a probability distribution, so you don't have many probabilities, you have one number for each pair of tipping elements. So calculating the entropy, give you information about what is the average surprise of observing, give you like the variability.
Chaos is
if basically everything is bowling, is you have every time the same probability or not. Actually, we didn't do that, but we know that we observed that this probability, of course, are not random, like they have very strong spatial correlation. And this is, of course, makes sense because, I don't know, when you compute the correlation between, when things are very close geographically, when you observe high correlation, so maybe low entropy, if you just, and then the things become more sparse, but even more surprising when you consider this long range, so this teleconnection they are called. So the answer is that, if you just consider the low scale spatial pattern, the entropy is low. Otherwise, you have more chaos. You have this, when you have this teleconnection, which are like the most interesting part. Yes, you have. Yes, but we didn't compute explicitly the entropy, so I think that's also a good proxy.
Over the years, the entropy of the ensembles, Change over the year.
Yes, yes. We don't know, but I don't think at the level of entropy will change a lot. What it changes like just how how the teleconnections are like how these tipping elements are like linked. So, but I'm not sure, to be honest. Maybe I have to check. Maybe it will change. Maybe it's a good suggestion.
Any more questions?
Right. I have a question about less data science, more about application. These results could be useful for data-driven, you see. About method, I don't know.
About you mean from the methodological the methods that we used was not developed specifically for this work. Was proposed by one of my collaborators, and so it's like a generic way to analyze networks. We believe that so the message from this work is that I think that we have to switch a bit of paradigm in how we analyze data, and also specifically networks, but in general there are in the literature there is this whole perspective of like this thresholding, so using statistical tests, which is good, of course. But I think one of the message of this work is that we have to switch a bit paradigm, and it's not difficult to implement these Bayesian alternative methods, which provides you other information that otherwise you will basically lose in the thresholding process. So I think from this work there is, okay, the climatological part, but there is also the methodological method. So I think that what we want to, yes, we want to give the message that these methods are easily implemented, because often people say, okay, but I just use p-value, I don't want to use other difficult methods to use this Bayesian framework. Actually, it's easily implemented. There are libraries also that do this. And it's also not very, they don't introduce a lot of computational efforts to do this. It's basically mapping between two matrices. So, I don't know if I answered your question.
Okay.
Maybe there is another
question about the repetition of the likelihood of the scenario. Like, have you ever seen a repetition of your analysis in time, like starting from the year 2020 and moving forward to the year 2050? Are there any repetitions of correlations, or is it only worsening the scenario, like moving towards degradation, like due to pollution, due to other climate factors?
When you say repetition, you mean so these results are consistent when we.
I don't like repetition of I don't know, say like cyclical.
Okay.
Cyclical,
now I understood.
growth, and
there is dynamics, oscillation.
Yeah, like a harmonic thing.
Oscillator
Like, yeah.
dynamics. Actually, there is no exactly a repetition, but okay, we have data like since because these CMIP projections also don't go only in the future, but goes also in the past. So what we have done is also repeated the analysis, just considering past periods, so like this from the early years of 1900 toward nowadays, and we wanted to see if there was some pattern similar to this. And the answer is that there is no clear this kind of pattern, but there are more like the one that you were mentioning. Things, so the effect was like weaker, but we even observed this kind of like the correlation pattern, and then again the increase of this correlation. So I would not say that there are not clear oscillations. There are more periods, like metastable phases, and then go back to the normal baseline. So it's like an oscillation with respect to a baseline. While here we observe like a small, like a clear deviation with another state that we don't know if it would be what will be like a new state, a new stable state, or this will go again back to the baseline. Like we don't know. We stopped at 2100. Yes.
Okay. So thank you, Thomas. Let's move on to Babatunde.
Is it okay like this? I still like this?
So Babatunde, with his talk on multi-time frame algorithmic trending signal. So a system. Sorry.
Okay. I would say buonasera and good evening to everyone. And I am Babatunde Monye, and I've been in the trading community for a very long time. I'm not actually a teacher, but I'm more of a mentor, not only in trading, but also in things that is related to financial markets. And from experience, I've lost a lot of accounts, and I've also back-tested a lot of algorithms. So that's why I have more of experience about how algorithm actually works, and mostly in line with trading. And my presentation today is basically on data management in algorithm signal analysis for trading apps. Because in 2023, after my specialized master's in Bologna, I decided to start running a trading service, which I'm currently doing now. And since then, I've faced some physical challenges, and which also made some backtesting that I did before irrelevant. So I would say I have really learned from experiences about trading itself. And in this presentation, I break everything down into 4 parts. Basically, understanding trading. Then in the understanding trading, we will be able to figure out the objective view of the market, because from objectifying the market, we can be able to understand how to model our algorithm. And algorithmic trading on its own, I will look at some parts of algorithm that we have. So in case I'm showing, I have some code here in which I want to show it to be easy for us to understand what we are basically looking at, as there are different types of trading algorithm. And in the third part, we'll be looking is where we actually be looking at the strategy creation. I simplify it and I made it in a more of a way in which a structural trader can be able to understand exactly what is being built or the intention behind the code itself. And lastly is how to measure risk in order, even if you build a good algorithm, what one have to take into consideration so that the algorithm will work well. And without no further ado, I think I can step in. And looking at the first one, which is understanding trading, is particularly is understanding the market participants. And before the year 2000, the most persons in the most people trading the financial markets, the forest to be specific, I think the forest is actually what I am much more specialized in, not in stock and not in crypto. So I want us to understand this, as it will also help us in everything that will be said here. And in understanding market participants, there is, till year 2000, it was only institutionals. And it was from year 2000 that, after the dot-com bubble, that the retail traders started picking up. People started trading directly from their homes. And as I'm talking to you now, almost everyone wants to go into trading, mostly now that there's this spike in crypto and etc. And secondly is, for us to be able to understand trading, we should also look at trading from time frame. And time frame can be the market time frame, of which we'll look into later, but time frame can also be the section logic, overlapping section and the countdown section. Like the forest in specific, we have about 4 sections, which is the Sydney, Tokyo, London, and New York. And if one is building an algorithm, it's very important one pay attention to this section, as this can tell if your algorithm is actually performing well or not. Because your algorithm might be performing very well in Tokyo's section, or might even be performing very well in the overlapping sections, and you might not know. And you might think that your algorithm are not good enough. So it's very good that we take into consideration about section. And the market correlation, fundamental or economical links, like I know many of us are aware of President Trump. I can tell you since last year, the market is not following what we know before. And this is why fundamentals are very important. So even if you build a very sophisticated algorithm, it's very important also you take into consideration about the fundamental aspects, which then take us into market structure, which is the 4th one. The market structure, what every trader or every person building an algorithm is trying to capture is always, is the market trending or is ranging? And from the understanding of these two, they can be able to understand how to really get something from the market. And I summed everything up in a way of looking at the market, which can be price action analysis, technical analysis. Also, notwithstanding that technical analysis is also, price action analysis is also inside the technical analysis. Just like here I put geoeconomic, which some people refer to as fundamental analysis. But geoeconomic is much more a suitable term for the forex market, because it tells you more to always bear in mind what each central bank of any currency is actually talking about or is holding, very important. And that's why I consider it to be more geoeconomic than the fundamental analysis itself, which is popularly known for. And the technical analysis is the combination of indicators. Indicators, most traders doesn't know how to build indicators. It's built by data science, but we use them. And when we use them, we pay more attention into understanding what the indicator is talking, because the indicator itself in price action tells us something as a trader. And this 3 analysis is often what takes into consideration in understanding trading. And once one understands this, one can be able to at least understand the algorithm he or she is developing. I put a little bit information down to understand each analysis, and this is particularly what it takes to understand what is price action. Price action is simply looking at the charts, and looking at the chart is basically trying to identify the chart patterns or the candlestick. I remember one certain time I had a debate with a financial, should I say, yeah, he's a financial person. Just let me stop there. And he was confusing candlestick to boss plot. And I was telling him that, yeah, I understand from a financial point of view, from a modeling point of view, that boss plot it behaves in a particular way. But when it comes to candlestick, you are talking about something entirely. And it's very important that even we as a data science, if we are looking at candlestick, we should view it differently from box plot. And here again, it's like the technical analysis. And when we talk about technical analysis, it's the combination of indicators. And this makes us to know some indicators have where they can tell you, okay, if you get to this stage, buy, if you get to this stage, sell, and like what we have, like this indicator here, tells you more of buy, and it doesn't tell you anything. And if you look at this indicator here, it tells you more about sell here, and here it asks you to close an order. So some indicators also have a way of already telling you when to enter and when to exit. And the indicators are much more built by data science, and it's important that we have this into consideration as when we are talking about algorithm, it will help us to understand actually when building a full algorithm what it is. Then the geopolitical aspect is, which is the fundamental analysis many people calls it, is to understand actually what drives the market. And from this angle here is something that the central bank doesn't have actions on, which is trading emotions. It's what drives the market is usually fear, greed, overconfidence, and etc. And this is actually what makes many quantitative traders to actually take loop of the market, because if they understand that there's how traders view the market, they can be able to manipulate the market. And understanding this as an algorithmic creator or builder is very important, as this can also make you to know how you can tweak your algorithm and etc. I know of a lot of things going on in the crypto market where people are being told that they manipulated the price just because of, and what they actually mix into effect is to put fear or to put greed to make people sell off or to make people buy, and etc. While the other angles that are not in our control is the central bank's effect, which can come from different angles, from sanction, trade policies, investment screening, energy resource, and diplomatic areas. Then here is when it becomes a bit more closer to what I am here for. And here is I put together the most important or the most known trading algorithms, executions algorithms, alpha algorithm. This alpha algorithm is often what many people are building. You know, they can tell you, I have an algorithm that can go into the market and make you and give you 30% of your portfolio and etc. What they're actually talking about is alpha algorithm. And another one is high frequency algorithm. High frequency algorithm are also another type, the sentiment algorithm. I put everything also much more in a way of understanding the execution of the execution algorithm talks more about the volume and price weighting. And this is often used by institutional traders to place orders so that the market will not notice what they are particularly doing. Although retail traders are now also doing such things, mostly if they are handling large accounts. And here we have the alpha algorithm. The alpha algorithms are often what many of us are familiar with, or is the one that is totally out there, trend following strategies or mean revisions or arbitrage. Arbitrage are not too much common for ordinary retail traders, but institutional traders often do arbitrage, or people in the political environment, they do arbitrage a lot. But we as retail traders, we often doesn't have that infrastructure or the inside information in order to do arbitrage. Then the next one is high frequency, and high frequency is much more market making. It's also institutional, and Skyping. Skyping is a retail trader can do Skyping. And even if in some sense, Skyping is not market making, and it might not be referred to as high frequency, but the reason why I included Skyping as a high frequency here is because it's the same thing of entering the market and hoping to capture a small sense and get out as fast as possible. And another one is sentiment algorithm. This one has been populated since the advent of machine learning and neural network. And this one is actually talking more about going to scrape the web, mostly scraping the trading communities to understand what is going on and placing a trade based on the sentiment from there. Some persons use it alone, but while some persons use it alongside other indicators. Then here is now, from this understanding, we can then think about building an algorithm. I think from now, if I then try to break down the algorithm in which I want to show us here, it will be more easy for us to figure out exactly what I am trying to do or what the instructions are trying to do in advance. And here is the lookup. I would say before you think about building an algorithm, is first of all the market knowledge, the trading knowledge, then you put together these two into an hypothesis framework. Then from there you can see the reality check if everything works well or not. And when it comes to the market knowledge, we are actually talking about time frame, as even if the forex market is 24 hours, we know that these 24 hours are break down into different time frames. And it's important when you are building an algorithm to understand that it might be high in a higher time frame, it might be a trending up in a higher time frame, while in a lower time frame is trending down or it's actually ranging. And understanding this will also make you to understand how you're going to model your algorithm. Then the next one is the trading knowledge. The trading knowledge is understanding price actions, understanding that whatever anybody is trying to build is totally trying to get the law of supply and demand to make sure that you are able to capture when other persons are going down, you follow them to go down, you sell, and when other persons are going up, you follow them to sell, etc. And tracking the markets is also another area in which tracking market structure. You want to know if market is higher high and lower low, and you also want to know if the market breaks resistance or is in support, and etc. And this taking this into consideration will then give you more insight in examining your algorithm and know what you can patch into the algorithm and etc. Mostly, specifically, alpha algorithm to be specific, as other algorithm might not involve doing any of this. Then another aspect is trading knowledge is when you look at an indicator in a chart, there is something that indicators are always saying, and many traders understand what the indicator is saying. Like they understand what is called higher high and lower high. Like if you see here where my mouse is, and you can see that there's a bearish divergence here. This indicator has been following this chart up until this point. And up until this point, we are having a lower low, a lower high from the indicator, and we are having a higher high from the chart. This can tell us that something is happening in the market. Something is not going well. There could be a shift or a change, a flip that is going on. And this is often referred to as divergence in the market. There's also convergence, and understanding this is very important, as when you are combining indicators, you know exactly what you want to get from the indicator, which information is important from each indicator. Then here is putting together the hypothesis. Like, just like as I said, I'm more now like a structural trader. So in the sense that I like to look at what exactly the market is being structured into. And this also helps in building an algorithm. And first of all, focusing on the market structure. When it comes to the market structure, we are looking at the higher high, lower low, lower high, and lower low, and putting everything down into a time frame. Then from a time frame, you can be able to see if the 1 hour time frame is different from let's say 15 minutes or 5 minutes time frame, which is change of character. Then break of structure is if you see that in 4 hours is trending and in 15 minutes is going down, then you understand that there's already something going on. And putting all these things together, these four together, can give us a very good indicator that might be able to represent this particular structure here. We can be able to dictate when this chart is flipping to the other side. And this is a bit of what it takes to come by from, I would say, from a rule-based perspective, or from breaking things down into smaller chunks. From its perspective, then we can be able to understand. Once we're able to build this into our system, then we can start be able to understand if what we should say is our entry rule, exit rule, risk, and position sizing. And here is where I put everything more together into a more modular form in which it can be easy for us to say, okay, if we want to code it or if we want to think about it in a coding perspective, what we are actually thinking about. And just like many traders are not interested in predicting price, but we are more interested in understanding price because we want to go where the money is. We want to follow the crowd, as they always say. And the first modular approach is a time series understanding, and which is the open, high, low, close, and volume, and modeling them into multi-time frame hierarchy. It can be anyone from 5 minutes to even monthly, depending on which one the person wants. And one other target is regime behavior. We want to know if it's trending, if it's consolidating, and if it's reversing. This helps us in order to understand how our algorithm is actually functioning. And from here, we have like the price fixtures. From the price fixtures perspective, this is the main, I would say, the jargon of the algorithm itself. As here is a relative close. Like when we are trying to build an algorithm, let me not say we are passing all the charts into the system, but we are passing each candle into the system to say, okay, can you check for us if the last 4 candles is less than the new one, or vice versa? And this is how we can be able to understand exactly what is going on in the market. And once we're able to do this, we can, one of the algorithms I will be showing us here actually is actually doing exactly what we are seeing here. And looking at it from this perspective gives us a way of being able to understand if it's trending, consolidating, and if it's reversing. And after which we look at everything from a multi-time frame fiction and look out for agreement. And this can also tell us when we can start thinking about when to enter, when to exit, and also our position sizing. Here we have like a core or algorithmic area, which is from a trading concept, which is equivalent to a data science concept, is like the indicator-based features. From the indicator-based feature is what you are going to get the information that you required to then do the cross resolution consensus to check for if there's any variance. Then which the 3 layer here, which is trending or consolidating and reversal, is what you look out for. And the last one is you determine the statistical favorable state, if it's actually trending, or if it's actually consolidating, or if it's actually reversing. And I think that is it. The next is for me to show you guys like the algorithm I have, because I put together a very simple and a way in which we can be able to see exactly what is here in the code. And this can give us more of a mental understanding of how we can be able to get this 3 information, which is it trending, is it consolidating, or is it reversing? And here I have my, this code actually, I think I put them on GitHub, and anyone that is willing to look at it can also see it there. I have already the 2 code I'm hoping to share here, 2 files, which the main reason I made it 2 instead of 1 is because they have to check out for 2 things. The first one I have here is the reversal signal. And the reversal signal checks for 3 things. It checks for momentum, exhaustion, and qualified. The momentum is to see if actually things are still going as planned. Is it still moving forward, or is it moving straight? Exhaustion is there a discrepancy in the market? Like, Is there something? Is the trend ending? And this is similar to the consolidation or to the reversal area. And another one in which I put together is the estimated manipulation movement, which is important now because of our dear President, Mr. Trump. Whenever he makes a speech, you don't want your algorithm to behave absolutely anomaly, like it will scatter things. And we will look into the algorithm as I have them already full here. I will run, after I go through the Jupyter notebook, I will run them on a full node so we can see the output it can give us from a trading terminal, a live trading terminal here. And yeah, I have the estimated manipulation movement signal and reversal signal. And I would say that the code are totally non-Py, no pandas. My main reason is I used pandas at the initial time, but it was a bit slow. And before anything could happen, things has already gone very far. So I decided to compute everything in, I prefer only pandas. So I can do more of a quick run just for us to see the outputs, and also so we can stick with time in case there's any question we can pick up from there. And here I have all the architectural overview, the real-time open, high, low, close, and volume, and signal engine, and socket I/O for looping, continuous looping. And I picked a very simple symbols and the time frame, and it will check every 1 second. Yeah, and these are the signal payload. The signal payload are enterprise, direction, target, risk, confidence, and count phases, and setup details, and etc. And these two algorithms were actually gotten from Louis Algo and Algo Point. I follow them very well, and they are very good technical indicator creator, and I learned a lot from them. And however, they implemented it in a different language, but because I like the concept, so I bring everything down to Python in a way that it will also make me to use to my own advantage. So here's more of the function that gets that gets the candle. It's on its own. It gets 50 bars at each run. And here is the momentum phase. And in the momentum phase, it goes for this here is a buy. It's a buy. I don't know how to put it again, but I think it's a buy features. Yeah, better way of putting it. It's a buy features, and here it's a sell features. I put all the information down here for basic understanding, like this particular codes here, because what we are trying to model together here are actually this aspect: enterprise, direction, target, risk, confidence, and count phases. And it's more important that we understand exactly what each of the features are doing. And this is the momentum phase. This actually checks if the trend is still going well or not. And it's still the same thing I explained there, which is at each 4 count of the candle, it usually checks if the next candle is greater or lesser than the previous one, in order to know if there is something going on in the market, if the momentum is still high or not. It takes the closing. It doesn't take the opening, because the opening might change as each candle as time evolves. And here is more of it, and it does a 9 count. A 9 count actually it does 4 count from here, But each 4 count, the 5th one are actually confirmation. Meaning, if he checks for each 4 counts, the last one, which is the 9, is actually a confirmation. And oftentimes, in as much as in coding, it takes that into consideration, but in a chart, it actually does not take that into consideration. It looks like all of them are the same. It's the more reason why we have it as a 9 total count. And here we have, this is the plot, and this is what it tells us. It tells us when to buy and sell. However, this is a simulated environment. We will run it on a real data, on a simulated data that's a dummy data, and it tells us when to sell, when to buy, and etc. And this is the exhaustion phase. The exhaustion phase often tells us if the chart has actually consolidated and if there is a flip in the price. And if I run the code, yeah, it can tell us, for example, it does check for pattern counts, and it tells us there's no exhaustion in the dummy data. Let's be specific. So, and here we have still looking at the momentum signal, which we then incorporate to say, okay, if the 9 bar count is plus the flip, which is the 8th one plus the flip, which is the 9th one, then it should be at least 50%. Meaning that we check for continuation, or is it done or not? Because if I want to take us back to this place, because things can get a little bit confusing here. We are looking for momentum count and exhaustion. Then if momentum and exhaustion are confirmed, then there is a flip. When there is a flip is where we then have the confirmation. Meaning the indicator itself is trying to follow what is already there. It only tells you when there is a change from what is already there. So from here, it's exactly it. If it is, if the momentum count is okay, it's 50% confidence, and it will continue and check for the next candles. If I run it, it will tell you, okay, momentum is signal buy and we sell. Still on the dummy data, and I will be running the real data here so we can see every information here. And this is also the exhaustion phase. And here is where I put together the three of them to say, okay, this is the qualified signal part and multi-time frame fusion. Okay, yeah, this is the multi-time frame fusion that checks for each of the time frame, still on only multi-time frame fusion, and checking for a mass count. Yeah, the buy count is set to 0. Okay, and this is what we have if it's a buy or a sell. Then here we have a put together of the three states, which is each of the state tells you, for example, signal type if it's momentum, and if it's exhaustion, and etc. This is, for example, breaking down of everything. And before I check on this, the second script, I think it's good if we look at this is the full code in a more with a real data coming from the MetaTrader terminal. And this full code checks everything step by steps and gets every information we want. And I want to run the code just so that we get what the real data is actually trying to put together here. And if I run into something like this, we have like a tabular form where it shows us all the, this is directly from a real data, and it tells us what is going on in 1 minute. This is also telling us a confirmation that momentum is okay, and in 5 minutes, what is telling us everything is okay. And you can see here in USD/JPY, it's telling us that it's a sell. And from here, we can think about continuing it or leaving it. And it checks for every minute in order to get working with time. So I want to make sure that we are not ahead. So yeah, and yeah, this is actually where it gets all the reversal monitor. The main orchestration is done here. And here is where the information is to say if it's B is buy, S is sell, and the momentum phase, if the momentum phase is active, meaning no trade, if you are not already in the trade. But if you are on the trade, you keep your, you still keep your open position. And once there is an E, which is an exhaustion phase, you are meant to exit from the market. I don't know if this is clear.
That's the difference of E and or a buy or sell. I mean, if you are in a position, if you bought some Bitcoin and you have a sell sign, what's the difference of exhaustion sign?
Okay, the exhaustion is like saying consolidation. Consolidation is moving up and it's coming down. And let me try to take us back here so we can understand it from exhaustion is more or less of a consolidation. From the 3 states we are looking at, yeah, this consolidation. Because before a market actually, or it's generally known that a market has fully crossed resistance or support line, it often sometimes touch back the support line before it continues. We want to know if that coming down is just ordinary retracement or a consolidation. If it's a consolidation, which is exhaustion, no, if it's a consolidation, which is a pullback, it is still okay. And it's something a bit similar to when a trade, I'm looking for a particular chart. Okay. It's something similar to this particular stuff you see here, this pullback. So, for example, this pullback could signal an exhaustion, but it's not qualified if also the momentum is not fading. It can signal exhaustion, but if the momentum is not fading, meaning everything is still in line, but the momentum and the exhaustion must signal as no, before we then say it's a flip. It's a little bit, yeah, I think it's very clear. Yeah, okay. Because that is, I think I have also, yes, okay. You can see in this chart here, we see this E, which is kind of, P means like perfection is okay, everything is going. Then E here looks like an exhaustion. But even when the exhaustion is still there, everything, even the P signals that everything is still okay. So even when the exhaustion is qualified, but if the momentum is not qualified, the exhaustion is kind of on its own. The exhaustion and the momentum has to be qualified, has to be to say, okay, then before we then say everything is qualified, before we then say, okay, there's a price flip, which is often interpreted as a convergence in the market, meaning there's something going on in the market. There's already a change in price. Even you can see also here something like this. You can see this one here. Now we have something like this here. And we can see also something like this here.
How do you avoid overfitting? Like,
Yeah, that is why we are looping each candle to avoid overfitting.
okay.
Yeah, because if we are checking each candle,
Online algorithm.
yes, like it checks as the time is going. Like you see in the code, I have it checking every 1 minute. And as it's checking every 1 minute, it's checking to make sure that everything is in line. Where did I write it? Okay, here.
And what's the win rate of this strategy?
The win rate?
Yeah.
Because it's a structural trading.
How many?
Because it's a structural trading perspective, the win rate depends on the market itself, not depending on you.
No, yeah, absolutely. The win rate, I guess, is a consequence of whenever you enter an exit position, correct?
Yes.
If you place 10 bets and trades, let's call it, and you win like six of it, and 4 you lose, of course.
Okay, let me break a little thing down for you. Like this type of strategy, if you want to use it to trade, because this is actually explaining trend, consolidation, and reversal. If you want to use it to trade, you will pay attention to the time frames. For example, if the signal itself is saying everything is okay, like if you see like what we have here, it's saying here in the daily that it is a sell, then you can look out what is going on here to enter, to re-enter. It's just like a dollar cost averaging strategy. And in this way, what you can backtest for will be how many pips can I think about getting. And this strategy on its own cannot work only for itself. It has to be added an execution strategy, the one that will be entering the position and closing the position. This one is just to tell you exactly what's going on in the market.
It's not clear now.
Okay. So,
I have a question, but do you think that market behavior is stable across time? So, because the problem is, okay, you have a lot of strategies, and maybe you see, okay, this one is the best. But when you, and maybe it's also related to the other question about overfitting, when you test your strategy on real data, how do you know that the strategy that you selected will, how do you know that your strategy still works?
I understand what you're trying to ask. I understand.
Because okay,
yeah, how you know if your strategy will work is, for example, everybody that built a very good system has once traded manually that pattern. Then, when you backtest that pattern, when you structure that pattern, you know what to expect. And that's how you know if that pattern is doing wrong or not. So, from your question now, how I know is, apart from to say it's not behaving like how I would trade if I were the ones looking at it. If it's not behaving how I would trade if I'm the one looking at it, because from here, we can already see what is going on here. And you see like it's doing checks every time. We can already see what is going on here. We already know that, because there's something I wanted to show, but now that it's like this, let me show it now. There is something every algorithmic creator or anybody creating a trading algorithm always wants to avoid. And pay attention to this here. this move is something that even we manual traders get confused. And here is where your question is actually valid, because if this move actually applied to our algorithm, does our algorithm have a good position for it? And if you watch how the algorithm actually checks, you will see that it has a very good position for it, because each is checking every new candle with the last 4. Meaning, if this particular one does what it does, you will be able to understand that there is a problem in the market. And that's actually what will then take us to market manipulation, the next script, which I wanted to show here. Because that script checks for this particular anomaly. And that's why, like, in building an alpha algorithm, most of the times you are not relying on one pattern alone or one algorithm alone. You are doing a combination of algorithms, and each of them are specifically checking for something.
Yeah, no, but okay, I understand. Yeah, but okay, my question was also more like, okay, you find an algorithm which works, but this means that there is the possibility of an arbitrage.
Okay.
Because you can gain money, let's say, for free. And so, since, as far as I understood, the market is also like...
the market hypothesis, the market is not...
Like you,
so it's random.
So if there is the possibility of make money, all the other people will observe that possibility and will start to trade. And the fact that they do this, they will...
That is where there's a difference between crypto and Forex. Because if you understand that Forex, the central bank are actually hedging their currency. So it will not move past a particular threshold.
Okay. Maybe on crypto is much...
Yes. What you're saying is very common in crypto. In crypto, it depends on who has the higher money. Even in Forex, it happens, but it only happens in commodity pairs. In the commodity pairs, you see gold is highly manipulated, because if you move the money into the other side, then other people will be thrown out, and etc. But in Forex, you can easily understand that. For example, the European Central Bank will not want the euro to go in a particular way. And once it gets to a support, every trader knows that support. And even if the algorithm itself, we know that every trader or the institutional traders have known that the price has arrived at a particular support, they will go in another direction. So we, as an alpha trader or building an alpha algorithm, should only tell our algorithm should always look out for what the market is doing. That is why I said alpha algorithm is not always predicting the price, but it's to understand the price, because understand the market. If it's able to sequence the market, only what you have to just pay attention to is risk management, which is for sure. It's just like the main reason why institutional traders use a particular pattern to enter the market, because they don't want everyone to know that they just pack their money into the market. So even you yourself as a trader, you should also understand how to also enter the market. There's the time. Okay, but the script is already in my repo, and if you guys want, I can share it. And any outside discussion, this is actually what I do, so we can discuss it outside of this place. And I just want to run this last one, just to show how the market behaves. Okay, this is the estimated manipulation. And if, for example, you compare the two of them, you might be able to be combining something. You will know when something is being manipulated or not. And if you combine the two algorithms, then you will be able to tell your script that is entering the market that when there is a manipulation, an anomaly, that you should not enter the market. Okay, and lastly, just to finish, just to round up, is when building a data system like this, and that gets real-time data, one of the things that I have faced is database locking, because, for example, this type of move here, when it's literally happens, your database might be locked, mostly if you are using SQLite. And it can lock. And one of the ways in which I counter it is to make sure that there is a write-ahead login, which is the whale mode, and a lock-aware entry with exponential back off with operations, and to clean up old data to ensure a new atomic badge. In this way, you will not have an old data that is still computing when the price has actually moved on. This has nothing to do with the reversal script, but when you are putting together 2-minute script together, you will find yourself in this position. Yeah, and the check notice here is market can be modeled as a state machine, usually, and price action contains sufficient information. However, if you are working for an institution, then you have to be thinking about order flows and volume profile, which is advanced concept. But everything is already in the price action. Multi-time frame alignment improves robustness. Sequential confirmation reduces false signal. And deterministic logic can evolve into a machine learning systems. Like if you see how I plug in the data, if you are able to model everything, you can actually use something like support vector machine, and it can do a lot of things from there. So thank you so much. And
thank you, and thank you, Thomas, for sharing your expertise with us. And
yeah.
Okay, so now let's move on to group update. The upcoming events. In May, we have AI Heroes in Torino and PyCon Italia in Bologna. AI Heroes is focused on AI-driven engineering, and PyCon Italia, this is the largest conference in Italy with focus on Python, Rust, data, artificial intelligence, machine learning, and coding best practice. In June, we have one of our meetup, and there will be AIConf and another AI Heroes event. AIConf is more focused on artificial intelligence as a whole, covering ethics, business, and technology. And in the summer, we have 2 workshops in Padova and Mestre. I don't know what in this moment, but I think one about automation or AI assistant, the first by Venice, and the second, data. So data about, I think, the transformation or similar. And yes, if you want to propose or suggest something, this is we have a form And we have another site to propose your talks. This is Sessionize, PyDataVE. And well, that's all. Let's say goodbye to everyone. No. There is nothing in online, so we can move on to the in-person networking. See you soon.